Section 1031 of the tax-deferred exchanges continued to increase in popularity as more investors nationwide discover the wide range of investment objectives that can be easily met through exchanging or swaps. Much of the increased use of the 1031 exchange arrived with the 58% increase in capital gains tax rates that arrived January 1, 2013. At Florida 360, we have put together a team of experts and partners to help you build wealth with Florida property investments. Keep that wealth legally, then pass it on to your beneficiaries. The U.S. government has raised taxes on investors, and the IRS has been charged with the task of replenishing the Treasury of the United States. Yet since 1921, American investors have enjoyed loopholes that provide enormous asset preservation features. Given the challenging conditions in the real estate market, some investors may be faced with the prospect of foreclosure or a short sale arrangement with their lender. Investors in this situation have a multitude of concerns ranging from a deteriorating credit rating to loss of their equity. Unfortunately, the taxpayer may have a significant tax liability that arises out of foreclosure or short sales. Please download the briefings that outline how to use the 1031 exchange in these circumstances to postpone capital gains tax liability. Florida investors have the added assistance provided by the use of land trusts in this circumstance to remove the distressed property from one's personal financial statement. The Tax Relief, Unemployment Insurance Reauthorization, and Job Creation Act of 2010 extended the Bush-era tax cuts until the end of 2012. On January 1, 2013, the investor tax rate called capital gains reverted from the 15% rate it had been under Bush to the rate that had been in effect prior to 2003. That would be 20%. You can postpone capital gains taxes on property, exchange like property in any other state, including investor-friendly Florida properties, and improve basis value in your lifetime when you work with our team. Want more incentive? Beginning in 2013, the National Health Care Reform legislation that became law in March of 2010 imposes a new 3.8% tax on certain investment income. The new tax will apply to single filers with incomes over $200,000 and married taxpayers with incomes over $250,000. Under the law, the investment tax provisions in Chapter 2A of the Internal Revenue Code are placed under the heading Unearned Income Medicare Contribution. In general, this new Medicare tax will apply to investment income that is subject to income tax, which includes capital gains. You can postpone this, thus avoiding the Medicare surcharge in the decades ahead through the 1031 exchange, and you may never have to pay that tax when you work with us. Are you a foreign investor? You have property investments in the USA, but you don't pay taxes here? The United States has tax treaties with collection privileges around the globe. Consider this: the IRS has hired 10,000 new agents and installed new forensic software to find and collect taxes. The law requires that your property managers withhold 30% of rent collected on your investment property if you are a foreign national, unless the property manager can provide proof of your exemption from FIRPTA. You don't ever have to lose 30% of your rent revenue stream when you work with us. The preservation of equity. Let me give you 5 of the best reasons to do a tax swap. A properly structured exchange provides real estate investors with the opportunity to defer 100% of both federal and state capital gain taxes. This essentially equals an interest-free, no-term loan on taxes due until the property is sold for cash. Often the capital gain taxes are deferred indefinitely because many investors continue to exchange from one property to the next, dramatically increasing the value of their real estate investments with each exchange. Leverage. Many investors exchange from a property where they have a high equity position, or one that is, quote, free and clear, unquote, into a much more valuable property. A larger property produces more cash flow, raises basis value, and provides greater depreciation benefits, which, therefore, stimulates stronger cap rates in the short run and a broader return on investment over the lifetime of ownership for the original investors and their successors. Diversification. Exchangers have a number of opportunities for diversification through exchange. One option is to diversify into another geographic region, such as exchanging out of an apartment building in Denver, Colorado for 2 additional apartments, one in Los Angeles and one in Dallas, Texas. Another diversification alternative is acquiring a different property type, such as exchanging from several residential units to a small retail strip center. Management relief. Some investors accumulate several single-family rentals over the years. The ongoing maintenance and management of what can be a far-reaching group of properties can be lessened by exchanging these properties for one property better suited to on-site maintenance and management. Exchanging into a single apartment complex with a resident manager is a good example of this strategy. Estate planning. Sometimes a number of family members inherit one large property and disagree about what they want to do with it. Some want to continue holding the investment, and some desire to sell it immediately for cash. By exchanging from one large property into several smaller properties, an investor can designate that after his respective death, each heir will receive a different property, which they can hold or they can sell. Call or write us for more information. Remember to always consult with an experienced attorney in matters of law and an experienced accountant in matters of taxes before making any financial decision. Thank you for watching. I'm Michael Belgeri.